Welcome to the Intermarket Analysis video update. This weekly video looks outside of the S&P 500 at other sectors, other indexes within the stock market. We evaluate the S&P 500 on a valuation basis. We also look at other markets because no market exists in a vacuum. So we take all this information together and look at it and then compare it to see how is the S&P 500 behaving. And can we get any clues as to whether that's a positive or negative thing? This is being prepared for Monday, March 31st. The areas that I'll cover first is valuation, both on a historical and forward-looking basis. We do an extensive look at growth versus value, and we're seeing a real shift so far in 2025 where the market is becoming more defensive. So value has been outperforming growth. In a more positive environment, growth would be outperforming value. We look at inflation. That seems to be a real fear in the market right now. We look at other markets, commodities markets, precious metals, things like that, just to see if they can give us any insight about the S&P 500. Then I go through and we look at the 11 sectors that make up the S&P 500. We look at the sector by themselves and then we compare it with the performance of the S&P 500. We look at some other indexes outside of the S&P, and then we look at correlations. A lot of times, if one market is going up, another market will be going down, or we'll see if they're both moving in the same direction at the same time. We look at some very long-term trends, and then at the very end, I come up with a positive and a negative list just to give us an idea of how different markets are holding up right now. First of all, we look at valuation, and this has been the same now for the last number of years. And even more than that, it's usually in the same state now that it's been in the past, where we have a PE ratio called the price to earnings ratio, because it's ultimately earnings that drive stock prices. And we compare the current price with what the earnings are for the S&P 500. And we're coming in now with a PE ratio of 20, which is quite a bit above this 20 level. So even though we've been dropping with the S&P 500 lately, we still should be at about the 4,000 level if you want to rank this on an earnings scale. So the market is considered to be expensive. This also looks at that same thing, but just plots some different events that have happened for the market and what the valuations were at that time. A variation of this looks at a smooth approach over a 10-year period of time with earnings. This was developed by Robert Shiller, and this ratio is coming in at 34.75. The median and the mean is between 16 and a little bit over 17. So even this is showing that on a valuation basis, even looking back, the market is still considered to be expensive. To give it a little bit more context, here is a standard deviation line. Typically, the middle area, that would be the average price. And when we get above this standard deviation one, that means that we're expensive. Even though we've been coming down, this is a little bit more dynamic standard deviation. It moves over time. This is also showing that we're overvalued. Then we look at this compared with other countries, and we have the US in black here, and then the developed markets versus emerging markets here. You can see again, the US is overvalued on a comparative basis. And then we break it down a little bit. The Magnificent Seven, the big high flying stocks. This chart's a little bit old, but we're coming in at about 25 here based on this. I have another chart that I'll show that also looks forward. And then comparing that with the rest of the S&P 500, we're coming in under that 20 level. That's kind of the line in the sand. When we're 20 or above, that's expensive. We drop down below the 19, that's more fairly priced, but getting to the high end of the fairly priced range. Here's another attempt to see where are we being expensive or inexpensive. This is again looking forward with the PE instead of looking back, but we're just bouncing off of this lower band. and coming back up. But still, when you take the number all by itself, it's still considered to be expensive. But according to this little more dynamic range, we've actually come to the bottom end of this range. Then this comes up periodically, and I've noticed that in 2025, with the S&P and all stocks really under pressure, we're seeing a lot more of these valuation studies coming up. When the market's going up, I still watch them, but you don't see as many charts or posts or concerns about valuation. It's when we start to go down, then they go, oh, wait a minute, the market's overvalued. Well, as of the last time this was updated, we're still over that 20 level with the S&P 500, and then it breaks it down into the 11 different sectors and what their current valuation is on a PE ratio basis. And this also is it's a valuation indicator showing that even with the declines that we've seen, we've been coming down with the S&P, a little bit of a blip down. It doesn't seem like much with a longer term chart. This goes back to 1985, but we're still up around this one area, which would be considered expensive. So that's just giving us an idea. We look at multiple different sources, we compare them with the big picture look, we break it down a little bit more, and we come to the conclusion that okay, the S&P 500 is expensive, but it's been expensive and it can still go up when it's expensive and become even more expensive. So I don't use that as a timing mechanism. I just take all the charts that we just went through and use them as more of an informational type of approach to say, okay, yeah, the market's overvalued, but then we use technical analysis to kind of drill down and say, okay, what is the market actually doing? The next area that I look at is growth versus value. And as I said at the beginning, we want growth to outperform value in a positive market. When value is outperforming growth, then that just means the market is usually becoming more defensive because there are money managers out there that run mutual funds or even hedge funds or ETFs, and they need to be invested in the stock market all the time. So if they see problems coming into the market, they may get out of growth stocks and get into value stocks. Sometimes value stocks perform well. It depends on what areas perform well at any given time, but it's not that they will always perform well. It's just that they may hold up better if we do go through more of a difficult time in the S&P. And we've been seeing a lot of that in 2025, where the stocks they lost their upward momentum back in December 2024 and have really been having a difficult time. We were able to get to a new all-time high on February 19th, but since then, we pulled back just about 10%. We bounced up a little bit. And then after this past week, things were looking a little bit better until we ran into Friday's session. And that was a pretty significant down day. And it switched a lot of what we were seeing as being positive developments suddenly going away. And at this present time, things are looking a little more negative. So the first thing we look at is the peer growth index, just all by itself. And it is in an uptrend, but you can see it's falling down and it's underneath its 200-day moving average. Then we look at value all by itself. It's still in an uptrend and hanging out about at its 50-day moving average. So just on a where is it in relation to the moving average approach, value is actually holding up a little bit better. And we do ratios. This is where we get the insight from. We look at a growth versus value ratio on top. You can see how growth is still in an uptrend compared to value, but really falling back down underneath the 200-day moving average with this ratio. And then an inverse of this same chart, because sometimes we can see things this way that we might miss with just the one chart where value has been outperforming lately. And then I have a number of different studies after this where we go through a lot of different areas, short-term charts, longer-term charts, just to see are we seeing the same thing throughout all these different charts? And we pretty much are right now. So first we look at a longer-term chart of the index where growth is in an uptrend compared to value, but falling back. And you're going to see that a lot in the charts that I go through here. An inverse showing how value has been underperforming, but since bouncing back. Some ETFs. Growth is in an uptrend compared to value, but pulling back. Another one showing how value's been underperforming, but now seeing a bounce. We look at a growth versus value ETF under some pressure here as we drop down below the rainbow. This is that same thing, but inverted, where value has been coming on strong lately. And a lot of this growth can really go back to the beginning of 2025, but we didn't know it was going to go up here at that time. Where it really started to break out was after we hit that all-time high in February and then have been coming down since then. That is shown where growth has been, or excuse me, value has been holding up quite a bit better. Then we look at a growth to value ratio here, a little bit shorter term, underneath the 200-day moving average with the ratio. Looking at the small caps, also same basic thing. Underneath the 200-day moving average with the ratio, back down below it with the mega caps, also below it with the S&P 500. And this is the ratio that I pay attention to the most. It's like, how do all these other ratios fit into this particular ratio? Since the S&P 500 is the focus of what I do and the classes that I teach and the strategies that are implemented, they all surround the S&P 500. Keep an eye on inflation to see, okay, what's the market saying about inflation? There's a lot of fears out there. Well, we are going up with the long-term chart of the CRB index. These are commodities, and we're above the moving average. The moving average is going up. Now, this is going to click over into a new move forward here with this chart as we go from March into April. But right now, all by itself, it's in an uptrend. Then we do a ratio, inflation versus deflation. Not really moving all that much, and we're still in a downtrend. But this downtrend has really been going on for the last few years. We'll see if this really starts to pick up. That means that the market, at least on a commodities basis, is going up, which could end up being inflationary. Here's the CRB index. In the weekly video, we showed that the CRB index is in an uptrend. Here on the daily side, in this video, I just mainly look at daily charts. It shows that commodities are in an uptrend here, and that's producing some of these inflationary concerns. The Baltic Dry Index, still in a downtrend, but it's been bouncing up lately. This is what does it cost to ship products from point A to point B, specifically in the Baltics. And this has been bouncing back up lately. So that's producing a little bit of concern. Then inflation expectations, which had been declining. This is a weekly chart. We've been coming down, but now it's starting to tick back up a little bit here. So this is some of those inflation fears starting to come back in to the market where they had been declining since the beginning of 2025. And these are the other markets that we look at. I just look at them in this video. I don't trade in these markets or invest in these markets. So we just kind of keep an eye on these. But here's aluminum, which is in a downtrend, and that's not inflationary. Corn, a real foundation of food, it is in an uptrend, but lately has been pulling back. And wheat is still in a downtrend. And we keep an eye on fertilizer because that's the foundation of growing things. It was starting to go back up, but lately it's been leveling off based on price. Oil, not necessarily inflationary. We're still under that 70 level. And we look at this just to see, okay, are is the environment inducive for oil price to go up? This can also be geopolitical as things are unsettled around the world, especially within the Middle East. This can really cause the price of oil to spike up if some kind of geopolitical event happens. But that's even though there's a lot of geopolitical things going on, it hasn't had a real impact, at least a lasting impact on oil to this point. And we look at a gold to oil ratio, and this, for the most part, has been going up as gold has been outperforming oil. And this is where we look at the oil, that's the red dash line, and then the 10-year yield. There's a relationship between the two. And right now, the correlation is pretty strong with each other. So if oil's going down, that means that the 10-year yield or interest rates are also going down, and vice versa. Gas is starting to go back into an uptrend now that the election is over. We were coming down here as 2024 was unfolding, and then we went sideways to end 2024. Now we're starting to go back up. And this is it's really helpful because this is an inflation gauge that affects most people. Gas prices going up and down every time you have to fill up your car. So this going up could be inflationary because this affects people the most. If they have to spend money on gas, they may not be able to spend it in other areas. Heating oil is still in a downtrend right now, and natural gas is in an uptrend. That could be impactful from an inflation standpoint. Diesel has been coming down for the most part lately, and copper. And this is uh, kind of confusing right now because copper is used as a barometer of the economy. When copper's going up, that means the copper market is suggesting that the economy looks good going forward. Well, if it's going down, that means there's seeing economic weakness. Well, you can see here, we're back to setting highs with copper right now, and it's in a solid uptrend, and we're seeing a good uptrend on the weekly chart as well. This is not suggesting that economic problems will come. Now, that could change because this can go up, spike, and then start to come down. But at least as of right now, it's looking a little more positive, and that bodes well for the economy looking out into the future because so many companies that build things, copper is the foundation of what they build. So if they're willing to buy it now to put it into their products, that means that, okay, the economy should be good going forward. If this is going down, that means there could be some concerns. And we look at a copper to gold ratio, which is still in a downtrend, but copper's been bouncing up. Now, gold's been doing well too, but for a while here, copper was actually outperforming, even though this ratio is pulling back a little bit lately. Longer term chart of the copper to gold ratio also plotted with the 10-year and 2-year yields and not really getting any insight here. We've seen this change where the copper to gold ratio has been going down as interest rates have been going back up, even though these are charts on different scales. Other times they tend to move in the same basic direction, but there's quite a wide spread between this now. And we're just wondering, does that mean that there's a general shift in the overall economy? And we're still waiting for that to play out. It's been the last 2, 3 years that we've been seeing this copper to gold ratio going down as interest rates were going up. Gold just coming off of setting an all-time high. Now I look at the gold ETF here, not the futures contract. So the prices that you might hear, the gold setting an all-time high, all that, it may not necessarily be reflected in this ETF. There is a difference in price. Silver is also in an uptrend. And we look at gold on top, silver, and then see that the correlation is getting stronger again, which means that they're going in the same direction at the same time. Then this is kind of interesting. We have a gold to silver ratio on top, and then we plot that with the US dollar index. When this is going up, that means gold's outperforming. When this is going down, that means silver's outperforming. And then we line it up with a correlation with the US dollar index. And there, it's a fairly strong correlated relationship in the meaning they're going in the same direction at the same time. The dollar, which has been under pressure lately, it's still underneath its 200-day moving average. The uptrend is still here, but it's really showing some weakness lately. And we look at the euro and just without any studies on here, just the euro versus the US dollar index. Another chart which also takes the euro and the dollar, but we add the Japanese yen, which is just starting now in an uptrend compared to the US dollar, which is what we see right here. We just saw a golden cross where the Japanese yen had been going down compared to the dollar. Now it's starting to go back up on a trending basis. The euro is still in a downtrend compared to the dollar, but just like the yen, it's really been going up lately. And we stay above both of these lines, and we could see a golden cross here, meaning that the euro is outperforming the dollar. And the same thing with the British pound, still in a downtrend, but really bouncing back up and above both of the moving average lines, but still considered to be in a downtrend until the blue line crosses back above the red line. Then different index ratios. I haven't been showing this chart in the daily videos as much because we're seeing more of it played out at a growth to value basis. And we're just trying to figure out. We see a few things switch over positive, then we have a down day or two and they switch back over negative, and then it looks like, okay, we're going to really shift and go down more. And then we have a couple of up days. Well, this is just showing the difference between the weighted version of the S&P 500, which is the index that we all hear about, and then they take an equal weight version where all stocks within the S&P 500 are treated the same because the S&P is a weighted index. So the bigger companies, Nvidia, Microsoft, Google, whatever they're doing, they have more of an impact on the value of the S&P 500, where the equal weight just treats them all the same. And we've been going down, especially in Friday's session. I did some pretty good technical damage to the market. Really going, we were holding up earlier in the week, but then we really broke down on Friday. And so we're going down with both the weighted and equal weighted version of the index. We're not seeing all that much of a difference here. They're showing that the equal weight is underperforming a little bit, but lately the equal weight has actually been outperforming. But these are on different scales. But when the red line's above the weighted version, that just means usually, in a general sense, that the equal weight version, the more value, the more balanced part of the index is outweighing the weighted version of the S&P. Yeah, this is another way to measure that with a ratio, the equal weight versus the S&P weighted version. And this has been coming back up lately here, just showing that the equal weight has been outperforming. And that's indicative of a market becoming more defensive. When we were really going up with this ratio, that means the market is under pressure. And this is 2022, which was a bear market. When this ratio is really going down, that's when we were really going up because it was the big stocks that were really leading the indexes higher. We look at a ratio between stocks and commodities. We're now seeing that a recent death cross is showing that stocks are underperforming commodities. This is that same chart showing how commodities are outperforming stocks. And the Nasdaq 100 and the S&P 500. Now both have been under pressure, but when this is going down, that means the Nasdaq 100 has been even weaker than the S&P 500. And the S&P 100 is underperforming the rest of the S&P 500. And the S&P 100 are the biggest stocks that make up the S&P 500. The Nasdaq is starting to underperform the S&P, even though both have been under pressure recently, and so far that's been the story in 2025. The Nasdaq 100 is, even though it's under pressure, it's holding up better right now than the Nasdaq. That's why we see this ratio going up. And then we look at the equal weight version of the S&P and compare it to the mega cap, the really big stocks. When this is going down, that means the mega caps are underperforming. We look at small caps, which have been under a lot of pressure. They just haven't really lived up to their hopes in 2025. A lot of that probably has to do with interest rates because interest rates are not really coming down all that much. And companies that are small have to borrow a lot more money. And if they have to pay that out for interest, that bleeds down into their bottom line. And so they're not as profitable. So this ratio continues to go down. And the S&P's been under pressure too. It's below its 200-day moving average, but small caps have been doing even worse. And this also shows that the blue line is the S&P, which is pulling back now, and then the red line is the small caps to S&P ratio, and that's been really underperforming. Then we keep an eye on the big rage these days, robotics and AI. This is seeing some pressure now. It's falling below this rainbow, which is another way to use to measure the trend. And then we do a ratio of the robotics and AI ETF compared to the tech sector. It's actually holding up a little bit better, but both have been under pressure recently. There's another AI tech ETF, which is still in an uptrend, but starting to fall below its 200-day moving average. The longer it stays down here, the more we might end up seeing a death cross. Now, this isn't a ratio. This is just looking at the ETF all by itself. Mega cap growth pulling back, starting to fall underneath its 200-day moving average, and that's showing some weakness. You can see when this is really going up, which is what we saw in 2023 and into 2024, that really leads the market higher. With this coming down, that's why the S&P has been going down. The Dow Jones Composite Average, which looks at the Dow, the transports, and the utilities together, still in an uptrend, but dealing with being underneath the 200-day moving average. Then here's traditional Dow theory, which just looks at the Dow and then compares it with the transports. And you can see that the transports have been breaking down more than the Dow. itself. So the Dow's actually been holding up a little bit better. But it's not just a value play for the Dow anymore because it includes like Microsoft and Nvidia was recently added. So there's some tech in the Dow, and that could also be adding to its weakness because these big tech stocks in there have been underperforming. But there's also a lot of value stocks in the Dow, and so it's been holding up a little bit better in that regard. But the transports have just not really been doing well now for quite a while, where utilities are not really breaking out, but they're at least holding up by going sideways. And typically, utilities are considered a defensive area. It's what widows and orphans get into because they pay dividends, and you just put them in these stocks that are considered safe. Then you can use the dividends to produce income. You could also look at certain areas as being more growth because of this transition over to needing so much electricity for AI, for electric vehicles, for cryptocurrency mining. All that requires a tremendous amount of electricity. And that's why you might at times consider this to actually be a growth area. And this is turning more negative too. And I usually base whether this is positive or negative by where's the S&P, where with the NYSE common stock, mid caps, and small caps, we're below the moving average and declining. Well, we had been holding out above the moving average with the S&P, and then after Friday, we're starting to drop below that. So this is turning more negative. We look at a ratio between the Dow and the transports. When this is going up, that means the Dow is outperforming. And here's the transports itself, which they were doing well for a while back in 2024, but then they've just kind of been breaking down and dropping lower currently. We look at a ratio between the transports and the S&P. When this is going down, that means the transports are underperforming. And we look at that correlation between the S&P and the transports. Excuse me, it's up in this red area, which means the correlation is fairly strong. Now, right now, the S&P has been going down lately, and transports have been going down, and they've been moving in the same direction at the same time. That's what you have when you get a high correlation. And then this is using a modified approach to Dow theory, where instead of using the Dow, you use the S&P, and instead of using the transports, you use the NASDAQ. And we're not really seeing anything all that strange here. We look for divergences. Is the NASDAQ going up or going down more than the S&P? Just looking at this, we're not really seeing any divergences right now. So it's more of a convergence. Then breaking that down a little bit further, instead of using the S&P, we use the equal weight version, which never has gone back and set an all-time high in 2025. That was mainly led by a short-term upward move of the mega caps back in February, but this never did. It set an all-time high back in 2024, but not one in 2025. Then we compare that with an equal weight version of the QQQs, which is the NASDAQ 100, and it's been under more pressure lately. It's great when this is going up because it tends to outperform the S&P, either weighted or equal weighted version, but it also tends to go down faster when the market is running into trouble. The FANG index has been hanging out around its 200-day moving average, breaking further below it on Friday. And this is a big part of tech, which are semiconductors. And even going back into 2024, this started to see a downtrend when we use a moving average crossover system. And it's still in a downtrend now, and these lines are starting to roll over as well. Semiconductors being weak right now is hurting the market. When this is really going up, like we saw at the beginning of 2023, and we actually generated an uptrend, this is when the market was really doing well. Now that we've been chopping sideways for a lot of the end of 2024 and now going down is why the market is not doing very well. And this is the semiconductor ETF, which is just coming off of setting a recent death cross here. That's a downtrend. That same ETF, but now it's falling further down below the rainbow. And you can see where these lines are starting to bunch up here. The longer we stay down here, the more these lines will roll over and could show that we might go into a downtrend. Then we're just starting a new downtrend here with the Dow Jones Semiconductor Index. It recently crossed and we're below both moving averages. This was an uptrend that goes all the way back to early 2023. Now we're starting to see a downtrend here. And then we look at a ratio between the semiconductors and tech, and both have been under pressure. And we're coming back down to the lower end of this range that we've been in since late 2024 going into 2025. And both are just not doing all that good these days. The Wilshire 5000 still underneath its 200-day moving average. Total US stock ETF this was able to get back above the 200-day moving average, but now it's fallen back below it. And then all world stocks. These are stocks all over the globe, but they take out US stocks here. This is actually doing pretty good. It's in an uptrend. But when we compare it to US stocks have really been underperforming. And that's why a lot of folks are looking at emerging markets, they're looking at Europe, they're looking at other areas outside of the US to invest in because US stocks have been weaker so far in 2025. ARK still in an uptrend, but down dealing with its 200-day moving average, a very popular ETF. Low volatility. This is what tends to go up when the market is considered to be becoming more defensive. Even though we were in an uptrend for pretty much all of 2024, it's that the S&P did even better. But now this is still holding up quite well. Where we're seeing a change is when we do a ratio, low volatility F versus the S&P. This is going down. That means the low volatility ETF, the more defensive stocks are underperforming. You can see we just saw a golden cross here with this ratio as the low volatility stocks are starting to outperform the S&P. Longer term chart here of a global index comparing it with the US, really coming down, but still above this red line, which is going up. Now we're going to be clicking over into a new month when we start to go into April, but this weakness just shows that international or global stocks have been holding up better, and we're rolling over with this momentum oscillator as well. Then we keep an eye on bonds, and they've been actually doing pretty good lately. And so this is bonds based on price. And we're just getting to the point where we might see a golden cross here, but we've been chopping sideways a lot in March. We've been more or less range bound lately. And then we look at a total bond ETF, which is in an uptrend. That's bonds based on price. And then we look at a long-term stock to bond ratio. This is going to click over once April starts, but for the first time in quite a while, we're actually still dropping below this blue line, which is a 10 month moving average here. Usually I use 12 months. That's why I was confused. But this is longer term. Now it's not falling apart, but the fact that it's going underneath the blue line is a bit concerning, as so far in 2025, bonds have been outperforming stocks. Then we look at the Pring World Bond Index, which is still in a downtrend. It was starting to come back up, but now it's pulling back down recently. And this is a daily chart of the yields where they gradually have been coming down and then they were chopping more or less sideways. But we saw them go down in Friday's session, but that didn't seem to help stocks, and stocks went down as well. And this is a weekly chart internationally. And I've been focusing on the Japanese 10-year yen or 10-year yield and also the yen compared to the dollar, where this has been going up, but the market's going down anyway, but it's not really causing the problems, at least we're not hearing about it, that were similar to what we saw last summer when this yield really started to go back up in August, and that produced that really bad day that we saw in August. Now, this is starting to break above the downward trend line here when we look at a bond to stock ratio, where bonds have been underperforming for quite a while. Now it's starting to show signs of improvement here. And then we look at high yield corporate bonds. We know them as junk bonds. This is probably encouraging for stocks because this junk bonds tend to basically follow what the stock market is doing. And the S&P has been under pressure, but this has been holding up and it's still at its 50-day moving average. Corporate bonds, more conservative bonds, after seeing some weakness, are now starting to go back up as they've been performing better. Then we look at a stock to bond correlation, and it's coming out of being neutral, but when this drops like this, that means they're having a tendency to go in opposite directions. And That means if bond prices are going up, stocks might be going down, and vice versa there. Junk bonds, which again have been holding up pretty good here in 2025, and that could be positive for the stock market. And then we look at a ratio, junk bonds to government bonds, risky to not as risky bonds, holding up fairly well here after seeing some recent weakness going back to the beginning of 2025. This is another ratio between risky and more conservative bonds, just coming down, but not really breaking down below the rainbow. This is holding up. And with the riskier bonds holding up a little bit better, even though lately they've been underperforming, that could be positive for stocks. But if this ratio continues to fall down below the rainbow, that could put some more pressure on stocks. Volatility of bonds measured by the MOVE index, volatility of stocks measured by the VIX, fairly high correlation between the volatility between the bond and stock markets. Corporate bonds, which were starting to go into a downtrend, have now come back up and are establishing more of an uptrend. Then I include these just because I have a whole list of charts that I always include in this video. This is a Fibonacci study, but we're in between these blue lines here, so we're not really getting any insight there. We're also showing how we've been shifting up into a higher range for interest rates after seeing a 40-year decline of that range. This is that same thing with the 30-year yield Fibonacci studies, but we're in between the lines currently. Then we look at some ratios between stocks and bonds, and this looks at the S&P 500 and compares it to 1 to 3 year bonds, short term. And when we're going down below the rainbow like we're doing right now, that means that stocks are underperforming short-term bonds. And you're going to see the same basic thing pretty much flowing through the charts that I go through, at least the next number of charts here. The S&P 1500, a broad market measure to 1 to 3 year bonds, also falling below the rainbow. Another broad market measure, but looking at 3 to 7 year bonds below the rainbow. Tech to 3 to 7 year bonds below the rainbow and declining. This is a ratio between stocks and bonds, but an inverse. So we look at bonds versus stocks. Bonds had been underperforming. Now they're starting to outperform. And we look at the S&P 500 with the 10-year yield, showing how the S&P is starting to underperform the 10-year yield. Then a longer term look at the 30-year bond based on price on a monthly chart where we've been coming down and we're still below this moving average here, but lately it's been improving a little bit. And then we look at the long-term price of bonds and do a ratio with commodities where even though bonds have been under pressure going back to 2023 and 2024, bonds based on price did not have good years. Now it's starting to roll over a little bit. We were bouncing back up, but commodities were doing even worse. That's why this ratio was going up. But now that commodities are outperforming, that's why we're seeing this ratio begin to turn down. And then just because it seems to be going against what's happening in the US, keeping an eye on the German DAX. That's the biggest stock market is in Germany in the EU. And so we keep an eye on that. And there's usually a pretty good correlation between EU stocks, specifically Germany and US stocks. Well, the S&P has been going down as the German DAX has been going up. And we keep an eye on the 10-year yield in Germany, which is really coming up in little, it's off of these higher levels as of late, but interest rates have been going up pretty significantly there as well. Then we look at different sectors, and this is where I look at the material sector first. I just show these based on the alphabetical chart of or organization of their symbol. And since it starts with a B, because all the different sectors start with XL, and then they have a different letter at the end. So we're in a downtrend here when we look at materials, and still not really seeing an awful lot of strength here, and also underperforming the S&P, which the S&P has been under pressure. Materials have been even under more pressure. That's why we're seeing this ratio negative. Communication, this is a growth area, still underneath its 50-day moving average, but holding up a little bit better when we compare it to the S&P, even though both have been under pressure lately. Energy, which is just chopping above and below these moving averages, it's seen some recent upthrust here and starting to show some improvement when we compare it to the S&P, even though it's still in a downtrend. Financials, and this is encouraging because we don't want to have another great financial crisis like we saw back in 2008 into 2009. And so this doing well is helpful, even though it's underneath its 50-day moving average and holding up better when we compare it to the S&P. This is actually going up with this ratio with the financials. Industrials underneath their 200-day moving average and pretty much going sideways, even though they're in an uptrend when compared to the S&P. Tech, this is where the market's getting more concerned. Going back to the beginning of 2023, just like we saw with the semiconductor charts here, the uptrend started. We've been in a solid uptrend, bumps along the way, of course. Now we're starting to begin a downtrend with the tech sector. And even though the S&P's been under pressure, tech's been under even more pressure. That's why we're seeing this ratio going down. Staples, another defensive area, still just coming up above its 200-day moving average. It trying to keep an upward trend here. The blue line is still just barely above the red line. And for the longest time, even though staples were doing well, they were underperforming the S&P, so this ratio was going down. Now it's starting to go back up, and that's a little bit of concern for the market. Real estate just kind of ebbs and flows, chopping sideways right now. Some of this has to do with interest rates, also with the housing prices just keep going up and up and up, which is great if you're trying to sell a house, but good luck trying to find a buyer. And so that might mean that folks have to start lowering price in order to entice buyers to come in. But lately, since it's also more of a defensive area, people have to live somewhere, no matter what's happening with the economy. So this has been bouncing back up, but lately it's been seeing some strength, but it has been in a downtrend. Utilities, as I already explained, usually defensive. You could also make a case for it being growth. This is in an uptrend, but so far in 2025, we've been chopping sideways, but it's still holding up better than the S&P itself on a ratio basis. Then this is going down. That means that the S&P is underperforming utilities. And if this keeps going down, that would be more negative. If we could turn this ratio around and start to go up, that would mean the S&P is outperforming utilities. That's not what's happening right now. It's just the opposite. Then healthcare, another defensive area, just kind of chopping sideways, pretty much going back to February. And this is actually a little more positive chart because it was the middle of February when we set that all-time high and have been going down since then. Well, this has been going sideways. So that's what I mean, where you don't see really any gains when you get more defensive. It's just you see less losses, which for a money manager, that can be a positive thing. And it has been holding up better lately when compared to the S&P after really underperforming it earlier on. Discretionary, this is kind of another growth area. This includes Tesla and Amazon. Down below its 200-day moving average and underperforming when we look at the ratio between discretionary and the S&P. Energy to tech, this we're seeing a change here where energy had been underperforming tech. Now we're starting to see a golden cross here as energy is beginning to outperform tech. That's another defensive area as well. Growth stocks versus more conservative bonds, where it just shows that growth stocks are underperforming underneath the 200-day moving average with this ratio. Then the tech sector is underperforming the 10-year yield, where the 10-year yield is outperforming the tech sector, another inverse chart. Discretionary to staples, when this is going up, discretionary is outperforming. Lately, discretionary has been underperforming staples. That's why we're seeing this ratio go down. And then an inverse showing how staples lately have been outperforming discretionary. Then gold compared to the S&P 500, the S&P is under pressure. The gold is doing well. That's why we're seeing this ratio going up. And kind of that same thing with the dollar. The dollar's been going down as gold's been going up. So this ratio is going up. The NYC composite, as I keep pointing out, this is actually holding up a little bit better. Not doing all that great, but compared to the S&P, the Nasdaq 100, the Nasdaq, and even the Dow, it's still well above its 200-day moving average and still in an uptrend. High leverage loans, seeing a little bit of weakness here. This is another barometer of the economy where this is really going up. Well, now it's rolling over a little bit here. It hasn't turned decidedly negative, but not showing the strength that we had been seeing before. Then all stocks, and then that includes US and international stocks, going down. That's mainly more of a drag on the US stocks are causing this index to have a little bit of problem. Emerging markets are in an uptrend. This is actually a little bit better looking chart. And so a lot of folks, they want to spread it out across the world. And so they might get into these investments. And we're still kind of hitting the low end of the range with the Japanese Nikkei. That's their main index, where we came back up to the high set in 1989, and then we've just kind of been conglomerating around this level, even though we're dropping down a bit as of late. Microcaps just starting to get into a death cross here. We're seeing the blue line crossing below the red line. These are real lot smaller stocks. They're even smaller than small caps. And Bitcoin also having a lot of trouble getting away from its 200-day moving average. And not seeing any real insight here. We look at the S&P on top and then the home builders ETF. That's been under pressure as the S&P has. We're not really seeing much of a disconnect right now. More of a neutral relationship between the two with the correlation. Then we're in a downtrend here with China. We're trying to turn back up with emerging markets in Europe, where we're in a downtrend in Japan, and we were trying to turn back up. If you take Friday out of the equation, we're looking a little more positive in the US. Now, this is a different type of oscillator. It's a KST, and it lasts a lot longer, or it's much slower. And then we look at the intermarket analysis chart. We're going back to the beginning of 2025. Gold is doing the best, followed by the price of bonds. Oil is at zero now, but still holding up better than the dollar, which is green, and stocks are actually underperforming. They're doing the worst so far year to date. And we look at some different correlations. The S&P to the dollar, pretty strong correlated relationship. So they're tending to go in the same direction right now. Where for quite a while in 2025, they were going in opposite directions. So if stocks were going up, the dollar was going down. If the dollar was going down, stocks were going up. I just said the same thing there, but vice versa of that. And then we look at the correlation between the S&P and oil coming down, but a little bit of a tendency to go in the same direction. Then stocks to the 10-year yield, they're going in the same direction right now. Lately, that's been down. And then tech to the 10-year yield had been neutral there for quite a while, but a slight tendency to go in the same direction, which lately has been down. Then stocks to the 2-year yield, fairly strong tendency to go in the same direction, and lately that's been down. Then we look at some long-term charts here. This is a monthly chart of the NYSE, coming down a little bit, but still holding out above this 12-month moving average, but rolling over as far as momentum. This is a daily chart where the NYSE record high percent index, when this is going up, that's positive. Lately, this has been coming down, but on a relative basis, the NYSE has been holding up better than the other stock indexes because it has a lot of value in it. Then we look at a monthly chart of the S&P starting to roll over, could be dropping below this 12-month moving average here, and that could be longer term negative. And we're also seeing the longer term momentum begin to roll over also. Then we look at a ratio between the S&P and commodities, showing how this is rolling over, the longer term chart. This is also a monthly chart. And then another global look here where we've been coming down with the US versus global stocks, but the momentum is still positive here. But this will probably click over and give us an updated reading once we get into April. So then at the end, we list all those things that are positive, and that's when the 50-period moving average is above the 200-period moving average. So growth and value all by themselves, copper, the dollar, Yen, let's see. The yen's actually in an uptrend compared to the dollar right now. The CRB index is in an uptrend, as is gold and silver. The mega caps, even though they've been under pressure, they're still in uptrends. The FANG index, ARC, all these things have been under pressure, but they're still, the 50 is still above the 200 period moving average. The low volatility ETF staples, the Dow Jones Composite Average, and then bonds, the total bond ETF, high yield, investment grade, corporate bonds, and junk bonds are all positive. Tech and high leverage loans seeing some weakness lately, but still holding up. The Dow, the NYSE Composite, and Wilshire, those are broad market measures. The NASDAQ and NASDAQ 100 are still in uptrends, as are the mid caps, but getting really close to a death cross. All stocks mainly held up by international stocks now. Emerging markets are in an uptrend, and Bitcoin, even though it can't seem to get above its 200-day moving average, it's still in an uptrend. And then those things that are negative, that's when the 50 period moving average is below the 200. The euro, the British pound against the US dollar, because the yen is now starting to go up in an uptrend against the dollar. And then the semiconductors, both all the different things that we look at, the SOX index, ETFs, indexes, they are all in downtrends now. And that's a concern. And the world bond index is still in a downtrend, even though it has been showing signs of improving. And then the small caps and micro caps, a new addition to the list here. That's not a good sign to see these in a longer term downtrend. Thank you. I hope you found this helpful. Have a really good weekend, and I will talk to you in the next video.